We now come to one of the most integral parts of mutual fund analysis, which is essentially the rating or ranking of mutual funds. How do we select mutual funds, or essentially a selection mechanism for mutual funds? How do we go about evaluating mutual funds and comparing them, right? We have touched upon a little bit of this in debt funds when we were looking at two funds and trying to compare them. But we are now predominantly going to do this analysis with respect to the equity mutual funds that exist. And obviously, a large chunk of this analysis also kind of goes through in terms of debt analysis. But the primary focus is going to rely on equity mutual funds. Some of the parameters obviously are exactly same in terms of replication when you're looking at debt funds as well. And we'll understand what those mechanisms are. Let's now solve the problem of rating mutual funds. How do we go about developing a system which basically helps us identifying a mutual fund? In other words, which parameters help us rank mutual funds, and how do we look at those individual parameters is what is our focus now. Right now, if you think about it, there are many parameters that you would presume are important. Obviously, the performance of the fund is important, right? Then you would probably want to look at who the fund manager is. Do you have any idea of the fund manager? Maybe you want to look at how old the fund is, so age of the fund. Maybe you want to look at what kind of size the fund has. How many more people trust the same mutual fund as you do? Maybe you want to look at what kind of, and size would be defined in terms of assets under management for the fund. Maybe you want to look at what kind of risk the fund manager takes. Risk could be in terms of the kind of sectors the fund is in. Risk could be in terms of the kind of portfolio concentration. When we say concentration, that means how many stocks does the portfolio have? So a good diversified portfolio should have about 30, 35, 40 stocks. Does it have more? Does it have less? How much of it is weighted in one or two stocks? So if the top stock, let's say the top stock has 30% weightage, is that good or bad? That's an extreme amount of risk on one call, right? If something goes wrong. Now, there's nothing like good or bad here. You have to kind of look at it in the perspective of who is the end investor who's going to use this as a data. So if you're looking at a risk averse investor, you don't want this kind of concentration in the portfolio, correct? You could look at what kind of expenses the fund has. You could look at a variety of other things as well as you go along, right? Let's try and identify some of the major parameters that a lot of the funds use, right? So typically, you're going to look at age of the fund. Older the fund, longer the track record, longer number of business cycles it has seen and survived. There are a lot of funds that are not able to last more than 2, 3, 4, 5 years. If the fund has actually lasted longer, if the fund has existed for 20, 30, 40 years, that's in a way a supporting factor saying that this fund manager has lasted business cycle, so they must be doing something correct, right? Fund manager. Is the fund manager ultra aggressive? What is the performance of the fund manager? What kind of style of investing does the fund manager have? Is the fund manager someone who's taking a very long-term view? Is the fund manager someone who's taking a short-term view? There are some fund managers, for example, who are very long-term, right? If you go on the website, they will say invest for more than 5 years, right? I would urge you to go and look at a fund house called Parag Parekh Financial Advisory Services, PPFAS mutual fund in India. And if you go on their website, they very clearly suggest that if you want to invest only if your horizon is more than 5 years, right? There are other fund managers who are more medium term in nature. You see that by their portfolio record, how quickly do they move around the portfolio, right? In which case you're looking at something like 1 to 3 years. So there are some funds which have less. So what's the style of investing? What suits your, as an investor, what suits your style of looking at funds? Then size of the fund. Two things. One, the bigger the fund, more people trust the fund, obviously, because it's like supporting or corroboration of the fact that if more people trust a fund, it'll have more money or more assets under management. So this is assets under management that we're looking at. Also, a lot of the expenses are fixed in nature, like salaries, etc. Right? Now, if the same fund manager is managing or the same team is managing a 10,000 crore fund, the expenses as a percentage are going to be lower. If the same team is going to manage a 100 crore fund, the expenses are going to be higher. So lower the expenses as percentage and lower the expenses, better it is, right? Returns. Whether the fund has been able to deliver returns, performance, and more importantly, consistently over time. Not just the last 6 months return, but last 1 year, last 3 years, last 5 years. Since the beginning of the fund, has the fund consistently generated returns for investors? Expense ratio. The fund with higher expense ratio is not being managed efficiently. It could be a function of higher costs. It could be a function of lower assets under management. But typically a fund with higher expense ratio is not being managed efficiently. Then you want to look at the portfolio concentration. Is the fund properly diversified? How many stocks does it have? 20, 30, 40, 50, 100. Typically, the best portfolios would be 30 to 50 stocks. That's the optimum portfolio size. There are some fund houses which have 130 stocks. That's not great. Too much diversification, too much of cost in terms of tracking all those stocks. The fund will never really outperform because there is no stock where you have taken a dedicated bet. Also, you don't want a portfolio with 10 stocks because you don't know what are the risks in terms of those 10 stocks. Ideally, that's the case. Now, there could be a risk taking investor who wants this portfolio, and there could be a very, very risk averse investor who wants this portfolio. So it depends eventually on the investor profile, but broadly, you want an optimum concentration of the portfolio, right? Load structure. There used to be earlier something called as an entry load. So when you invested in a fund, there used to be a cost there. That has been abolished in India now. There are still exit loads. So if you take out money from a fund, sometimes the funds restrict your redemption or taking the money out of the fund. So sometimes, the structure, they don't want you to take out money in less than 1 year. So for less than 1 year, there is going to be a bigger exit load than for more than 1 year. Sometimes they have laddered points. So you could have a 2% exit load for less than 1 year. You could have a 1.5% exit load for less than 2 years, 1% exit load for less than 3 years, and nothing, zero after 3 years. So you could want to kind of rate funds based on load structure because an exit load is going to create a sort of a liquidity risk for you. You can't get out of the fund whenever you want to get out, right? And finally, what is the risk a fund takes? So returns of the fund in isolation are not important. We have seen something called a Sharpe ratio. The importance of Sharpe ratio is in terms of giving us an idea of risk adjusted returns. So how much risk has been taken and what is the excess return generated per unit of that risk is what Sharpe ratio tells us. Just saying that fund A's returns are better than fund B's returns may not be enough till the time we compare their volatility, we compare their beta, right? So the measure of risk becomes an important metric in our overall calculation of fund ratings. There are certain set of ratios which are typically available for funds in their fact sheets, etc. So for example, we already know about Sharpe ratio. That's return of the fund. So that's portfolio return minus the risk-free rate divided by sigma of the portfolio, right? Information ratio is something similar, just that instead of using the risk-free rate, it is going to use the benchmark return. Every portfolio is compared to a benchmark. A large cap fund would be compared to Nifty. A mid cap fund would be compared to NSE mid cap. So you look at the benchmark return and try and find out what is the excess return you have generated over and above the benchmark, because the investor could have otherwise invested in benchmark directly, right? Divided by the volatility of the fund. So excess return over the benchmark per unit of volatility, excess return over risk-free rate per unit of volatility. Trainer ratio is excess return over risk-free rate per unit of beta that the fund has, right? So systematic risk that the fund takes Trainer ratio gives you that data. And then finally, there is another interesting ratio called the Sortino ratio, right? To understand Sortino ratio, let's understand what happens in periods when the stock markets fall down, or generally markets go down, right? So when markets go down, when markets fall, there are two issues with mutual funds. One, the MF portfolio is going down. So that's the first problem, because obviously the market is falling and the portfolio is comprised of some of the stocks of the stock market. So those portfolios are also going down. The second is markets are falling. So this triggers some sort of a panic reaction in investor, which results in redemptions. Now, when redemptions are happening, when people are redeeming money from a mutual fund, the mutual fund is forced to sell stocks. When markets are falling, you will not be able to sell the bad stocks. What will be sold, because you have to sell in order to give the money back to investors, you have to sell. And what sells is a lot of the time the good stocks. So if markets are falling, fund performance suffers. Suffers purely because you have to sell some of the stocks that are getting sold easily, and in order to fund the redemptions that are happening because of the panic that the investors are in. So there are two hits that happen. One, the portfolio is going down, and second, the redemptions are happening, and both these result in a scenario where typically mutual funds underperform when markets go down. So MF usually goes down more when markets go down, right? That's where the real metal of a mutual fund manager gets tested. So Sortino ratio looks at what is the excess return a fund generates only on the days, and it compares it only to the days where the markets have gone down. So it looks at only the downside volatility. In simple words, if you look at the last 1 year and look at the days when the markets fell, you are effectively trying to compare the performance of the fund on days that the stock market fell, because on those days typically funds tend to underperform, and if a fund has actually performed well on those days, then in all probability that has scored well on Sortino ratio. In all probability, the fund manager is a really good fund manager who has been able to anticipate the downside issues that the fund might face, right? Those are the key parameters that we use in terms of rating. Now, when you look at rating, you could assign a series of weights to all of these, and those weights could differ from one person to another. Those weights could differ from one company who's rating to another company who's rating, but in itself it will cover more or less these similar parameters as you're looking at, right? If you're evaluating debt funds, to this you will look at the credit profile, right? And risk is kind of going to get captured there in the form of duration and modified duration, and to an extent credit profile, right? So that's the parameters that will get judged in terms of rating of debt mutual funds. All of the others more or less remain the same. So let's now turn our attention to calculating all the risk adjusted return ratios for Reliance Top 200 fund. So we will have to go to the fund fact sheet of Reliance Top 200 and try and calculate what is the return that they have. We'll take 1 year return. We'll take the risk-free rate. We'll take the volatility, right? We'll take beta if it is available, and we'll try and calculate the Sharpe ratio, and we'll try and calculate the trainer ratio. Sortino is typically difficult because Sortino is not available. We'll also try and see if we can calculate the information ratio if we have the benchmark returns available with us, or we'll assume a benchmark return and try and calculate the information ratio based on that, right? Let's turn our attention to the fact sheet of Reliance Top 200 fund. So that's what you see. If you look at the Reliance Top 200 fund, that's the fact sheet that is available. Let's look at what kind of returns they have generated, and I'm only going to look at the last 1 year returns. Last 1 year returns are 23.91% returns, right? Sorry, that's the NAV. Scheme returns are minus 1.36, right? Now, this might skew our calculations. So for beginning, we are going to use something that is positive. So let's look at the 1-year returns between June 30, 2014 to June 30, 2015. We can then turn and calculate these numbers as well. So 20% is the return that the fund has generated, as we see here, and the benchmark returns are 12%. We will assume the risk-free rate to be 8%, right? So let's note all of this down. We have the fund return as 20%. We have the benchmark return as 12%. We have the risk-free rate as 8%, right? Let's quickly look at what is the beta that the fund has. So beta is given as 1.04. Standard deviation is 4.94. It is, however, important to understand that the standard deviation has been calculated taking monthly rolling returns. So the return for the last year has been calculated. So we have to convert this 4.94 into annual standard deviation, right? Beta is 1.04, so we can put in the beta value there. So let's put in the beta value as 1.04. Standard deviation is 4.94. Remember, this is monthly. How do you convert monthly into annualized standard deviation? If you remember, we have done this earlier. When you annualize standard deviation, whatever period you are taking, you have to multiply by the frequency or under root of the frequency. So when you take monthly standard deviation, you multiply it with the under root of 12. Why is that? Is because first you take the monthly standard deviation, you square it, that becomes the monthly variance. Monthly variance is then multiplied by 12, and then you take the under root of this. So effectively, you're taking the monthly standard deviation square and square root of that. So monthly standard deviation into under root of 12 is going to give you the monthly, the annual volatility. So you multiply this with under root of 12. What is under root of 12? That will be somewhere around 3.4 something. So 5 into 3.4 is approximately going to be equal to 17%. Roughly about 17%, approximately 17% is what we are looking at. Do we have the data to calculate Sharpe? We have 20% minus 8% divided by 17%. That's the Sharpe ratio. So 12 by 17. That's going to be equal to approximately 0.7, 12%. 20% minus 8% divided by 1.04. That's 12% by 1.04. That's my beta ratio, trainer ratio. And 20 minus 12 divided by 17, that's 8% by 17%, or approximately equal to 0.45. That's going to be equal to my information ratio. Now, in itself, this is not useful. You can't directly compare it unless you choose to compare it for another fund, right? So we've already calculated the Sharpe is 0.7, information is 0.45, trainer is somewhere around 12% divided by 1.04. So we'll assume this to be 12% itself, right? Let's compare based on the metrics. So we're going to look at, we're going to compare top 200 with Reliance large cap focused fund, right? So on the basis of Sharpe, trainer, and information, I'm going to note that down for top 200 here. And Sharpe is about 0.7, this is about 0.45, and trainer is 12%, right? And we're going to look at Reliance large cap focused fund here, and we're going to look at Sharpe, trainer, and information ratio for this as well. Then we are also going to compare the assets under management. We're going to compare the age of the fund, and we're going to compare whatever other data is available with us, right? So let's calculate the data available for top 200 fund. Assets under management available is 2,200, 2,300 odd crore. So that's 2,300 odd crore. 2007 is when it started. So the age is approximately 9 years, right? Let's go to Reliance top 200 fund, which should be available. So we are looking at large cap focused fund, that's here, right? Assets under management is given as 1,050 crore, started in 2006. So the age is slightly bigger, age is 10 years, and this is 1,050 crore, right? Let's look at the return numbers. Beta is 0.98, standard deviation is 4.66, right? Just remember these data points. Again, we'll look at the same period returns, 15.74, 9.95, right? So Sharpe ratio is going to be 15.7 minus 8% divided by sigma. Sigma for these guys is 4.66, slightly lower than the previous guys. The previous guys was 4.94. So in this case, 4.66 multiplied by 3.4 is what is going to come as the number. So this is going to be slightly lesser. This works to about 15.8%, or I'll take this to be 16%. So effectively we get close to about 8% divided by 16%. That's 0.5. Trainer is going to be 8% divided by 1, which is going to be 8%. Information ratio is going to be 15.7% minus approximately 10% divided by 16%. So that's 6 by 16. 6 by 16 is going to be close to 0.38, right? So on all the risk adjusted parameters, you will choose top 200. On the age parameter, you will choose Reliance large cap focused fund. On the assets under management parameter, you will choose Reliance top 200. We can obviously dig deeper in terms of trying to find out what is the concentration of stocks. So you could look at what kind of sectoral weightages they have, and you could be focused on one sector more than the other sector and get the data based on that. Reliance large cap fund has only 25 companies, right? So you will not have more than 25. You can count it here: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, about 23 odd companies here. On the other hand, the top 200 fund will have a lot of other companies as well. So top 200 fund would probably have 50 to 60 stocks or 40 to 50 stocks at least. So concentration wise, top two, the focused one is more concentrated as compared to the other ones, right? We don't have any data that is available to us in terms of expense ratio, etc. So based on the parameters, it seems like top 200 is a slightly better bet in terms of risk adjusted return, as well as in terms of the total assets under management, which is in a way supporting our evidence that more people trust this fund, right? That's how we go about doing rating of funds. You could obviously extend this in terms of rating on multiple other funds as well. Now, there are a lot of other websites like Crisil, ValueResearch Online, Morningstar that also rate mutual funds. And they have this entire methodology of rating mutual funds. You could just do a search for mutual fund rating methodology with the name of these websites that are there, and you will get the data. We'll review some of them now. So let's look at Crisil. Crisil basically rates them on superior return score, mean return and volatility, downside risk probability. Remember, Sortino is something that we were looking at. Portfolio concentration, liquidity, how easily can you get in, get out, asset quality for debt funds, modified duration for debt funds, and size, AUM that we were looking at, assets under management. And then they give a fund rank 1, 2, 3, 4, 5, which is based on very good performance in the category, good performance, average performance. They all do ratings within a category. So you will rate large cap as a category, mid cap as a category, small cap as a category. You can't compare a large cap fund with a small cap fund. That doesn't make sense, right? You can't compare a long-term fund with a short-term fund in debt. That doesn't make sense. So it's important to ensure that your category is the same when you're comparing funds. Then you can use varied weights of these. They've in fact also given weights that you choose. So for large cap, small cap, and mid cap, 50% weightage is given to returns, 25% weightage is given to volatility, company concentration as 5%, sector concentration as 10%, equity liquidity is 10%, whether it is a closed-ended or open-ended fund, whether there's an exit load or not. And they look at it for a 3-year period, and they look at only funds with minimum of 1,000 crore of assets under management. And then you basically kind of rate those funds, right? So that's the weights. These are the weights that they choose. Right, so 50 plus 25, it adds up to 100% weightages if you see. The weights for for long-term income fund or long-term gilt funds are different. What is the return score that they have? What is the liquidity that they have? What is the modified duration that they have, right? Obviously, volatility is less in these gilt funds, so you don't really put too much weightage on the volatility in those. That's Crisil's rating methodology. Morningstar does saying that they kind of come up with based on enhanced rating returns, adjusted risk adjusted return measure, and they look at, which also accounts the effects of all sales charges, loads, redemption fees, and the ratings. And the top 10 percentile funds, they just put all the funds in a percentile normal distribution kind of a thing. The top 10 get 5-star rating, the last 10 get 5-star, and then 25, 22 and 0.5, and the middle one gets 35. And based on that, they basically come here. They also give some details about the enhanced risk measures that they use. So typically, original methodology, of treatment of risk was different. Now they have said the rating is based on expected utility theory, which recognizes that investors are more concerned about a possible poor outcome than unexpectedly good outcome, and willing to give up some portion of their expected return in exchange for a greater certainty of return. So they introduce some of these concepts which are slightly different as compared to what Crisil does, right? Value Research Online has a fund return grade based on which it kind of classifies them again in a same normal distribution. Fund risk grade classifies them there, and a combined of these two gives the rated funds, which are 5-star, 4-star, 3-star, and so on and so forth. So when you go on any of these websites, you will get funds rated with this methodology. And that's how people kind of say that a 5-star rated fund is a good fund, right? And a 4-star rated one is a reasonable fund. And you don't want to pick a fund that is a 1-star rated fund. So the stars are nothing but a mechanism of saying what is the ranking that the fund that this particular website has done for that fund, right? All of these, just search for fund rating methodology with the name of the company on Google, and you'll find the sheet that is available. We'll anyway share that with you. As we come to the end of this section, a couple of quick questions that we have. Name any 5 parameters that you think are important in rating a fund. Explain how assets under management becomes a criteria for fund evaluation. Thank you.